that's not abnormal. Well, eightfold for gold right now would be $8,000 plus because our bear low is 1,050. So, and there are factors out there, frankly, that could take gold up to a normal logarithmic scaled move. Well, what's 2% of $8,000? Okay, you get my point. Silver could go berserk just to get back to normal level. And I'm betting that if you ever get silver back up over 35 again, and again, oh gosh, we're going to make a new high. Who cares? That kind of thing. That spread's going to break out.
Renowned analyst Michael Oliver, known for his momentum structural analysis, has reinforced his bullish outlook on gold and silver. He forecasts a powerful growth phase, especially for silver and gold miners, as the stock market weakens. He highlights the significant rise in gold prices while noting the relative underperformance of silver miners despite their gains since 2015. In 2024, gold surged by over 25%, primarily driven by investors seeking protection against geopolitical instability and inflation, while capitalizing on rapid price gains fueled by rising demand. As 2025 unfolds, these factors remain relevant, with additional concerns about how the current administration's policies may impact the economy. As a result, many investors continue to view gold as a reliable safe haven asset. Silver, known for its volatility, has experienced significant price swings over the past year. Between February 2024 and February 2025, its price ranged from a low of $22.42 per ounce to a high of $34.72 per ounce. While silver has trended upward, it has struggled to maintain levels above $30. Now that prices have crossed this threshold again, investors must assess the right time to buy or sell based on current market fundamentals. Key factors to watch include global geopolitical developments and potential interest rate changes from the U.S. Federal Reserve, which could heavily influence silver's trajectory. According to Oliver, silver surpassing $35 could ignite a significant breakout. However, he emphasizes that this wouldn't be an unprecedented move but rather a return to historical price patterns. Michael Oliver also notes that the XAU index, which tracks gold and silver miners, historically traded between 17.5% and 30% of gold's price from the 1980s until 2008. However, following the subsequent bear market, this ratio collapsed to around 4% by 2008-2015. Since then, the XAU index has stabilized and currently sits at approximately 5% relative to gold. Oliver suggests that if this trend reverses and breaks out of its current range, gold miners could see their relative value triple compared to gold over the next 1 to 2 years, potentially outperforming gold significantly on a percentage basis. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
Right now is a 1.14%, I think, 1.14%, the price of gold. If you go back for the last 50 years and check out each year, what was the best reading silver had each year expressed as a percent of the price of gold? 20 of those 50 years, it was at least 2%. Wow. Okay. Now, if you just go to a routine, 22% again, big deal. You've been there before, 20 years out of 50. So it's really not excessive in any way. Well, even 2% of $3,000 is off the page. Okay.
Yeah.
Imagine gold goes up, a number I've thrown out before, which is nothing but a logarithmic scale number. If you look back in its past 50 years, there have been a couple eightfold moves, from bear low to bull high, went up eightfold. That's not abnormal. Well, eightfold for gold right now would be $8,000 plus because our bear low is 1,050. So, and there are factors out there, frankly, that could take gold up to a normal logarithmic scaled move. Well, what's 2% of $8,000? Okay, you get my point. Silver could go berserk just to get back to normal levels.
Right.
And there have been times it's been 3.5%. One time it was 6.5%. Forget that. You could get up to 2-3%. It's no big deal. And right now we're 1.14. Well, we're measuring daily action. Frankly, we're down to a microscope level, measuring that stupid spread. Going back to that October high when it was up at 1.28% or something. There's a structure such that if you uptick a couple good days, you'll get a one. And I'm betting that if you ever get silver back up over 35 again, and again, oh gosh, we're going to make a new high. Who cares? That kind of thing. That spread's going to break out. And I'm going to bet we're going to rush up to 2%. And again, you could do the math on that. Gold doesn't even have to go up much. Just getting 2%, silver would be off the page. So
That's huge.
yeah. So, but the miners, if you go back, and we ran a spread chart going back to the 1980s, where we measured the monthly close of the XAU index, which has been around since the 1980s. And it's not an ETF, it's an index of gold and silver miners. Back then, between the 1980s and 2008, XAU index lived in a spread relation to gold of 17.5% low to up to 30+% high. So in a range where its price, if you divided it into gold, would be either 17.5% on the low end or up to 30% of the price of gold. That was its normal range for decades. 2008, it broke down, coincident with the bear market that later followed in silver. And that spread collapsed all the way down to about 4% off the page. That was 2015 low. Since then, XAU is firmed. It's up around 5%, I think now, in relation to the price of gold. So actually, since 2015, the XAU index is up more than the price of gold on a percent gain basis. And that spread is above that low, but it's been in a range, a deadfill range at very low levels. And that range is very definable. If you break out of that range, there's no resistance on the spread until you get up to about 17.5%. The old lows, okay, well, that's a tripling of the relative value of the gold miners to gold just to get back up the bottom of an old multi-decade floor. So if you break that spread out of this 10-year wide base, and I think you're going to do it, it says, geez, over the next year or two, we could see miners go 3 times up more percentage-wise than gold does.
During the run-up to the financial crisis, the S&P 500 experienced a strong rally, nearly doubling in value between the bottom of the dot-com bust in 2003 and the end of 2007. However, despite this impressive growth, it underperformed gold by approximately 40% over the same period. AI-related stocks have seen an extraordinary surge, driven by relentless demand for AI chips. Yet, a critical question looms. Is this momentum sustainable, or are we witnessing an overhyped AI bubble on the verge of collapse? According to Michael Oliver, a tipping point is rapidly approaching. He predicts that major stock indices will suffer a decisive breakdown within weeks, triggering a massive reallocation of capital into gold, silver, and mining stocks. This shift, he believes, will ignite a decisive breakout phase for precious metals and their related equities. Now, let's redirect our attention to a video.
It's the thing that's obvious to most people is that silver miners aren't following, right? But meaning, like, for instance, gold's way out above its 2020 high, which is at $2,070. Okay, silver. Yeah, it's out above its 2020 high, but it hasn't made a new high since October. Yet gold's continued up. And the miners are still capped, in the low to mid 40s, GDX for example. And so, they look like they're lagging, but actually, if you go back and measure percent gain in price since, let's say, the 2015 bear low, miners are more than gold. Hard. They are. Percent-wise, they're actually up more than gold. And if you just go back over the last year or so, in fact, we'll update that this Friday, February to February, what's the year to date, 12 months. Silver, I think, is going to be up more than gold on a percent basis, and miners as well. And they're all of them are beating the S&P and the NASDAQ. What? That's not mentioned on any of the business TV channels, or it's still everybody's focused on the bubble. We think, and we've been arguing for months, that one of the key factors for gold at this point, and the miners in silver, for the monetary complex, is that the bubble break in that paper asset category, the stock market. We argue it's the biggest bubble in U.S. history, stock market bubble, both in duration, multiples of gain since 2009. And we know the reason. You look at an M2 chart or look at a Fed funds chart, hey, we've been on drugs for 10 to 15 years, and even when they raised rates recently, it's still at such low levels that even the recent peak in rates on the short end doesn't even compare to the prior 50 years. So we've been in hallucinogenic world in terms of that paper asset category. It's been spoon-fed drugs. And when it breaks, it breaks. This is the history. When it breaks, the money goes somewhere. It doesn't just go up in smoke, okay? And then it goes into gold. But 1900s, early 1900s, 1929, 32, you couldn't trade gold. Roosevelt banned it, but Homestead went up 1,000%.
Yeah.
And all the bull market peaks since then, mid-70s, dot-com peak, 2007 peak. If you went in and bought gold then, you did quite well, not just for the duration of the bear market in stocks, which is only a couple of years, but then stocks laid in the wasteland for sometimes a decade before they could even get back to the price high of the parabolic. And all during that time, gold just going up and up. So we think that's one of the key factors right now in gold, is to punch a hole in the bubble, watch the money flow. And our bet is, yes, you're going to see it in gold, more so than we've even seen it now. In terms of upside exaggeration, be far more accelerated, but mainly in the miners and silver. The miners are a place, such a small, little, tiny category, that when big hands reach for it, when they realize that, hey, it's been doing quite well despite what we've been looking at in the stock market, the miners have been beaten us. And yet nobody knows that. When they move that money in there, it's going to be like a wet bar of soap. I think you're starting to see the tonal change already in, for example, the day-to-day action of GDX. Sometimes you'll get a down day in gold or silver, and GDX will be up, or gold will be up 0.5%, GDX up 3%. It's a difference I've noticed over the last month. And I think that's partly a sign that there is money starting to move out of that broken bubble. And the numbers it takes for MSA to declare top in place for the stock market are literally a handful of percentage points below where NASDAQ 100 is right now. And I think in the next few weeks, you're going to see that trigger hit and the money flow will become exaggerated.
As markets grapple with uncertainty, history suggests that equities, even during strong rallies, can struggle against the enduring strength of gold. While AI-driven stocks have soared on the back of unprecedented demand, questions about sustainability persist, raising concerns of a potential bubble. Meanwhile, often overlooked precious metals and mining stocks have been quietly outperforming over the long term. With growing signs of instability in major stock indices, investors may soon shift capital toward gold and silver, seeking refuge in assets that have historically thrived when financial markets falter. Gold and silver miners have lagged behind bullion for years. Do you think they're due for a significant rally? Join the conversation. Share your thoughts in the comments, give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.